Okay, let's talk about it. AI stocks are on an absolute tear, just shooting straight for the moon. Everybody's talking about it, everybody wants in. But it brings up this huge question, one that's giving a lot of people a serious case of déjà vu. We need to break down what's really going on.
So here it is, the big question on every investor's mind. Is this the future unfolding right before our eyes, or are we just walking straight back into one of the most painful market mistakes in history? You've seen this movie before, right? The flashy new tech, the mind-boggling valuations, and all the promises of a new economy. And we all remember how that one ended.
And believe me, the stakes could not be higher. Just look at that number, $5 trillion. That is the amount of wealth that just vanished when the dot-com dream finally came crashing down. It's a really sobering reminder of what happens when hype gets completely disconnected from reality.
So what does this current AI mania actually look like? Well, the numbers are frankly staggering. You've got CEOs dropping the word AI in earnings calls like it's a magic spell, and you've got everyday investors getting swept up in this massive wave of FOMO, the fear of missing out.
The speed of these gains is just incredible. I mean, this is not your steady, predictable growth. This is what analysts call parabolic, where the chart line basically goes straight up. You look at a company like NVIDIA, up 1,500%, or Supermicro, up a jaw-dropping 2,000%. This is exactly the kind of explosive rocket ship movement that has people screaming bubble.
To really understand the risk here, we have to rewind the clock. Let's go back to the late 90s. The parallels are pretty striking, and the psychology that's driving the market today feels eerily familiar. The similarities to what happened back then are almost uncanny.
And this right here is where you can see the real danger. Remember companies like Pets.com or Webvan? They were sold to the public as the future. They had the story, they had the hype, they had these sky-high valuations. The one tiny little thing they didn't have? A viable business model. They went from being media darlings to completely worthless, taking billions of dollars of investor money down with them.
When the mood finally shifted, boy, did it shift fast and hard. The NASDAQ, which was the heart of the tech world, lost nearly 80% of its value. This wasn't some gentle correction. It was a total collapse that took years and years to recover from. Now, what's so crucial to get here is the psychology behind it all. Back then, you could literally just add .com to your company name and watch your stock soar. Today, the magic word is AI. In both eras, the narrative, that exciting, sexy story about the future, became way more important than the actual numbers, things like revenue and profit.
And this is a huge but. This is where the story gets a lot more complicated. It's really tempting to look at all this and think it's an exact repeat, but that would be a mistake. The AI boom is not simply the dot-com bubble part 2. There are some fundamental, really powerful differences this time around.
The biggest difference really comes down to one thing: real money. Unlike so many of those dot-com flameouts, today's AI leaders have actual customers paying them real money for products that provide real value. This isn't just speculation on a dream. We're talking about massive adoption by huge companies and measurable boosts to their bottom line.
The poster child for this difference is, of course, NVIDIA. This isn't a company that's built on a dream. It's a company built on the essential hardware, the picks and shovels that powers the entire AI ecosystem. It has become a legitimate cash-printing machine with profits that are almost hard to even wrap your head around.
Okay, so how do we make sense of all of this? Well, the best way is to stop thinking of AI as just one single thing. We need to start breaking it down into different layers, because each layer has its own level of risk and its own potential reward. So think of it like 3 tiers of risk. At the very top, in Tier 1, you've got the foundational giants. This is kind of the safe zone with the infrastructure players like NVIDIA and Microsoft. They will almost certainly survive any crash. Then in the middle, Tier 2, you have the bets. These are promising companies that could win big, but they're going to face some extreme volatility. And then, at the bottom, we have Tier 3, the danger zone. This is where the real bubble is. It's full of zero-revenue startups and pure hype stocks.
Understanding these layers is absolutely key to navigating this market intelligently. It's not about trying to time the market perfectly. It's about having a clear set of principles to guide your decisions so you can avoid that hype trap.
So ultimately, this all comes down to discipline. Don't just chase a cool narrative. Chase actual earnings. For the core of your portfolio, stick to those foundational Tier 1 companies that are the backbone of this whole revolution. Stay far away from the random penny stocks in that danger zone, and always remember that even the strongest companies have corrections, big pullbacks in their stock price. And if you remember just one thing from all of this, let it be this: the technological revolution is real. AI absolutely will change the world,
But that does not automatically mean that every single company with AI in its pitch deck is a guaranteed winner. Not even close.
So you see, the real question isn't, is there a bubble? It's, are you investing in the right part of the bubble? The bubble won't burst for the real leaders. It's going to burst for the junk. The challenge isn't timing the market. It's telling the difference between the revolutionary companies and the speculative trash.